Hi everyone, it's Andy here. I recently returned from a trip to Australia where I was fortunate to sit down with many Montaka and MFF clients. We discussed the current market environment, which is certainly complex today, and we were able to step through just how we are applying Montaka's investment philosophy in service of our overarching goal to exploit long-duration market inefficiencies. We shared a few examples of some counterintuitive things that we're seeing in markets today and just how we're interpreting these. Of course, as listeners will know, we always try to apply a first principles lens to what we're seeing, and we try to break the problem down in a very open-minded way. So what we thought we would do for this month's Spotlight Series podcast is share with you an excerpt from one of our presentations, and we will make the slides available in the show notes and in the Montaka Monocle email as well. So we hope you find these insights helpful or at least thought-provoking, and as always, reach out if you have any thoughts, feedback or questions. Enjoy. At Montaka, our goal is to generate sustainable excess returns from long-duration market inefficiencies. What we find is that markets tend to persistently undervalue businesses that can sustainably grow their revenues and earnings over really extended time horizons. And there's probably a range of reasons for this, not least of which there's a lot of short-termism and a lot of short-term focused market participants out there. And so we really do see significant mispricings in very long time horizon opportunities. So the way we structure our portfolio of global opportunities is we look for opportunities which are beneficiaries of long-term structural change, they're competitively advantaged, and then of course we always check for undervaluation as well. And we have a repeatable process, especially around the identification of interesting and emerging trends and transformations, and we're increasingly using AI to assist us in that process. And then finally, we structure our portfolios to be high conviction, long duration, and we're very benchmark unaware. So to give you an example, our top 10 investments typically account for around about 75% of our total portfolio. And we see significant opportunity out there today. And the reason why we see significant opportunity out there today is because the world is changing significantly at an accelerating rate. There are many themes that we're invested in today, as you can see showing on the chart. And what's interesting is, some of these themes have been around for a while. You've seen them before, but let's not forget, they have a long way to run. They have many, many years, or in some cases decades, still to run. And then of course, there are some really important emerging themes which haven't even started yet. Now, what's most important is that for us, the theme alone is insufficient. We could name plenty of themes for which there will be no winners. If there are no barriers to entry, if there's no ability for businesses to generate or build or strengthen a competitive advantage, that's not interesting to us. So what we do is we start with the theme, we start with the long-term structural transformation, and we overlay a competitive analysis to try to assess if there's one or a handful of businesses that either have competitive advantages today or even better can build and strengthen competitive advantages over time. And what we find is that if you're a business that is both well positioned in a long-term structural transformation and you have competitive advantages which are growing or strengthening over time, then you have a much higher probability of being one of those rare opportunities that can grow your revenues and earnings over a really, really extended time horizon. And we know those are the sorts of businesses that the market routinely undervalues and underestimates. And of course, we don't just take it for granted that that opportunity is undervalued. We, of course, assess the valuation from first principles to make sure there really is an investment opportunity there. So a key question today is whether or not equities are generally overvalued. It's a topic of great debate. There's plenty of press about it. If you look at the S&P 500 and take the P ratio of the index, you can see that it is definitely above its average level. Today it's up around 25 times, well above its average of around 17 or 18 times. Now, there are a couple of reasons why that P ratio actually should be above its average level. So for instance, today growth expectations are much higher than they have been on average in the past. That helps to push up the P ratio above its average. Interest rate expectations are below their long-term average, so that also helps to push up the average of the PE ratio of the S&P 500. Even credit spreads today are below their average. That also helps to push up the PE ratio above its average. So there are genuine reasons why the S&P 500 should have a PE ratio probably above its average. Is it a little too high? Maybe, but it's probably there or thereabouts. Now, what we find particularly interesting is if we dig into that average and look at the distribution of PE ratios. So if you look at the chart showing now, this is, you take the top 500 companies in the US and you say, what is the PE ratio of each company? And then you put them into buckets. So the first bar on the left, for instance, that is saying that out of the top 500 companies in the US, 51 companies have a PE ratio of less than 10. And then if you look at the next two bars from the left, okay, so that says roughly half the companies in the S&P 500 have a PE ratio between 11 and 30. And then if you look at the three bars over on the right, you can see that there's nearly 90 companies approximately that have a PE ratio either north of 60, or the PE ratio is undefined because their earnings over the last 12 months is negative. So there's really a wide distribution of PE ratios in the S&P 500 today. It's interesting to keep that in mind. Now, the other thought experiment you can do is to say, is it as simple as the companies in the buckets on the right-hand side, those are the overvalued ones, and the companies in the left-hand side with the low PE, they are the undervalued ones. And it's actually not always the case. And in fact, there are special circumstances where even the reverse can be true. So let's dig into a couple of examples. So let's start with low PE stocks. So here are two companies that have very low PE stocks today. I'll start with the company on the left. So this is Charter Communications. This is a cable company in the United States. PE ratio of 7, looks really cheap. But then when you dig in and say, oh, but what about the trajectory of the future earnings power of this business? Well, the earnings of this business could easily become impaired over the short to medium term. Why is that? Because lots of households in the US are cutting their cable subscriptions. They're finding that they can just watch YouTube on their phone or Netflix on their phone. They don't actually need to be paying $100 a month or whatever it is for their cable subscription. So the E in the PE ratio, the denominator, may well become impaired in the future, and that low PE ratio of 7 might still be too high today. Similarly, you look at the company on the right-hand side, that's Molson Coors. They're a beer company. Similarly to Charter, their earnings power over the medium term may also become impaired because younger generations simply are not drinking as much alcohol as older generations. And so beer volumes are in long-term structural decline. Of course, this company has been trying to offset the decline in volumes with increases in price, and they've been doing that for several years. But even that has its limit, and at some point that runs out of steam as well. So there's some risk there. It is possible that the PE ratio of 8 times for Molson Coors may well also be too high. Now let's jump to the other end of the extreme, a high PE stock. So here we're looking at Spotify as a case study. Now this is really interesting because over the last 3 years, the stock price of Spotify has gone up 10x. And Montaka has fortunately participated in this upside on behalf of clients. And over this period, the PE ratio of Spotify has been very, very high, often over 100 times. And yet throughout this period, objectively, in our view, the stock has been extremely undervalued. Now, how is this so? Well, for a business like Spotify, they've spent the last 2 decades building out their platform. They are clearly the undisputed leader in digital audio streaming. They've been incurring losses for more than 20 years, and they've only recently just become break even. And if you look at their future earnings power compared to their current earnings power is a tiny fraction of what it's going to be in the future, which means that the PE ratio, the value of the market cap divided by current earnings, well, current earnings are not really relevant in that equation. It's all about the future earnings. So for businesses that can grow their earnings power reliably into the future, it is possible for a high PE ratio to actually be too low. So let's generalize that a little bit more. In the chart showing, we asked the question, what is the general case for when a PE ratio that looks high might actually be too low? And it is when growth is both reliable into the future and high probability, as well as that growth being unusually profitable or extra profitable. So let me step you through this chart. So the chart on the left shows Spotify's revenues, which are clearly growing very well historically. And when you look at the drivers of those revenues, we can forecast those into the future with some degree of reliability and assess that that revenue growth has a long way to run. So if you think about user growth, Spotify is up to, a little over 600 million users. There's 8 billion people in the world. There's a long way to run there. In terms of pricing, there's a lot of pricing that they can exert. I think everybody who uses Spotify would agree that the value to cost ratio is extremely high, and the pricing could go a long way up before users start to churn. Advertising is only just getting going with Spotify now. And then, of course, they're going to layer on new verticals as well over time. So we think revenue growth in the future is highly reliable. Now, what's interesting is that the revenue growth is also extra profitable. Now, what do I mean by that? If we look at the chart on the right-hand side, it shows the operating profit margin of Spotify on the vertical axis, and that's that squiggly blue line. So as you can see, the business has only recently turned profitable, and now its operating profit margin is around about 10%. That's just operating profits divided by revenue. But what's very interesting is that if you look at the profit margin of just the growth, which they call the incremental profit margin, it's up at 70%. So it's saying every incremental dollar of revenue is coming in at a 70% profit margin. And what this means is that over time, if that incremental margin remains at 70%, it means that that blue squiggly line will sort of track up towards where that pink dot is. So that is an extremely attractive set of combinations: reliable growth, extra profitable growth, and those are the ingredients that go into a situation where your future earnings power is reliably much higher than your current earnings power. And when you have those conditions, it is possible that a very high PE ratio may not be as big a problem as you might first think. So at Montaka, we own many businesses which have reliable earnings power growth in the future. Here are just a handful shown on the screen. The way to interpret this chart is for each company, if you say, look, what is their 2024 earnings? And you index that number to 100, and then the blue bars show what the earnings will be 5 years later. So what you can see is that for a Tencent, Alphabet, and Blackstone, the earnings power roughly doubles in 5 years' time. For a Floor & Decor, Amazon, it's a triple, and for Spotify, it's 4 times higher. So when you think about what drives the future equity value of a company or the future stock price of a company, well, for businesses that can reliably grow their earnings power over time, it's the growth in earnings power that dominates that equation and is the most important factor. The starting PE ratio for those sorts of companies is relatively less important. So let me summarize. So the world is changing rapidly. There are lots of companies of the future, such as a Spotify. We'd even throw in a DoorDash into this category. These are established businesses, high probability winners of the future, but their current earnings are a tiny fraction of what their future earnings is going to be because they've just built out their platform, they've only recently become profitable, and while their growth is reliable, the growth is coming in at profit margins much higher than their current average. So their earnings power in the future is going to be much higher than it is today. Similarly, there are businesses of today, such as a Charter Communications or a Molson Coors, for which their medium-term and longer-term earnings power might actually become impaired. Second, we observe that the usefulness of PE ratios erodes quickly when there are significant changes to a company's earnings power, both up or down. Now, this is an obvious statement, but what's perhaps an interesting philosophical thing to ponder is that if it is true that the world is changing at an accelerated rate today versus the past, then it must also be true that the usefulness of PE ratios today is perhaps less than it was in the past. We throw that out there. And then finally, we do see opportunities out there in businesses with reliable future earnings power uplift. How do we find those businesses? Well, at Montaka, We always start with the structural transformation. We apply a competitive overlay to work out if there are businesses with strong and strengthening competitive advantages within that structural transformation. And then we always check for undervaluation to make sure there's an investment opportunity as well.